When Chinese real estate giant Evergrande Group defaulted on a $500 million bond payment on August 31st, many wondered what it could mean for China's economy. The company, which sold $20 billion worth of property in the first half of 2020, is one of China's largest developers and has been called a household name. Its financial health, or lack thereof, is seen as a bellwether for the Chinese economy. While Evergrande says it's still able to pay off its debts, investors have taken its failure to make timely payment as a sign of trouble to come for the broader economy. The company has racked up debts totaling nearly 1 trillion yuan, or $146 billion, since 2016, Bloomberg reported in June. Amid growing concern about China's debt-fueled growth, the International Monetary Fund, or IMF, warned last week that the country is facing risks from an overheated property market and rising corporate debt levels. Evergrande is one of China's most indebted companies and is about to be downgraded to junk status. The company, which is in the process of restructuring its debts, has long been regarded as a ticking time bomb on China's financial markets. The IMF said the high debt load was likely to become a problem for other large groups too. This possesses risk for financial institutions, especially when many of these loans were provided by smaller banks. IMF spokesman Gary Rice told reporters in Washington this week, "We encourage authorities to continue monitoring and strengthening macroprudential oversight." A top IMF official issued a warning to China's ruling Communist Party last week, saying that its control over the economy is causing a crisis that could lead to social unrest. The warning from the International Monetary Fund's top China expert David Lipton came after Chinese real estate developer Evergrande announced it was unable to pay $4 billion in debt. Evergrande is the country's largest developer of residential and commercial property, and its failure has triggered fears of a broader financial crisis in China. Lipton said the economic problems are rooted in the Communist Party's attempts to control all aspects of the economy. The Chinese government has been trying to run an economy where they have micromanaged everything. They've tried to manage investment. They've tried to manage trade, he said. That has led to an enormous misallocation of capital. He noted that while some state banks have made bad loans, private banks have also been affected by lending money to companies that have ended up failing because of poor management and oversight. The IMF also said that ties between government and private companies are too close to China. It believes this is causing problems for the country's financial system. In an economic report, the IMF said that the Chinese government should consider ways to better separate itself from the country's financial system. The report was released earlier this week. China's growth rate slowed down to 6% in the third quarter of 2019. The country experienced its slowest growth since 1992. Officials at the National Bureau of Statistics blamed a trade war with the US, as well as changes to China's tax policy for slowing growth, Bloomberg News Agency reported. The International Monetary Fund says China's GDP may have slowed even further to around 5%. In its report, it said that Chinese officials should consider steps to reduce debt levels and get rid of inefficient state-owned businesses. The report adds that these steps could help prevent future financial crisis in China, Bloomberg reported. China's central bank cut its benchmark lending rate for the fourth time since last year on Tuesday, which will lower borrowing costs for businesses and households starting October 15th. The move was widely expected after data showed industrial output slowed in August to a 17-year low, while fixed asset investment also lost momentum. The IMF advised China to consider additional monetary policy easing and said the country could still achieve its 6% growth target this year if policymakers embrace more aggressive stimulus measures. The International Monetary Fund issued a warning at the World Economic Forum annual meeting in Davos yesterday that the global economy has started to recover, but there are still many challenges ahead. The long-term growth rate of the global GDP has been declining since the 2008 financial crisis, and this trend will continue to be difficult to reverse. It is expected that the global economy will grow 3.3% this year and 3.6% next year, which is lower than 4% before the financial crisis. Although China's GDP growth rate in 2020 will be 6%, it is expected to drop to 5.5% this year and 5.5% next year, which is close to the pre-financial crisis level of 5%, suggesting that China's economic growth rate is approaching a medium-term trend that can only be sustained by productivity gains and technological progress rather than rapid investment expansion. Evergrande's debt-to-equity ratio has exceeded 1,000%, said Bank of China International strategist Linus Yip Sing Chi. It is not the first time that tensions have arisen between Japan and China over disputed islands in the East China Sea, but the events of last week were a stark reminder that the situation is still fraught with risk. A Chinese frigate locked its radar on a Japanese destroyer and a helicopter, prompting Japan's defense minister to warn of dangerous acts that could lead to an unexpected incident. The flare-up came as Tokyo is mulling whether to allow its Coast Guard to use weapons against foreign vessels. The decision may be aimed at bolstering Japan's ability to defend territories it claims in the East China Sea, including the Senkaku Islands known as Diaoyu in China, but it would also inevitably be seen by Beijing as a provocation. Chinese leaders have been using increasingly strong rhetoric to back their country's sovereignty claim. They do not want to appear weak on this issue at home, but they also do not want the spat with Japan to escalate into open warfare. A Chinese naval vessel recently approached a US spy plane in international airspace, according to news reports, putting Beijing and Washington at loggerheads as well. Beijing has also been increasing its maritime presence in waters near Japan and Taiwan. Japan's row with China over disputed islands in the East China Sea has shifted to the economic sphere, with Beijing confirming that it had suspended exports of rare earth minerals to Japan. A senior Chinese official said supplies had been stopped because of a legal dispute and had nothing to do with territorial claims. The minerals are key for Japanese manufacturing, particularly for making mobile phones and hybrid cars. Beijing has also announced it is investigating Japanese car firms, including Toyota and Nissan, over possible antitrust offenses. China's Ministry of Commerce said it was looking into the pricing of spare parts sold by Japanese firms in China. Japanese Prime Minister Nato Kan told reporters on Tuesday that he was very concerned about the rare earth issue. Rare earth is not a mineral that can be easily replaced by another, he said at a news conference on Tuesday, adding that any restriction on imports would be extremely regrettable. Hong Kong's economy has grown at an average annual rate of 6.5% since it returned to Chinese rule in 1997 and is enjoying its longest expansion since the 2008-2009 global financial crisis. But the city's economic growth slowed to 1.1% in the second quarter due to trade tensions and weakening mainland demand, the lowest since 2016. Its retail sales fell 7% during July, the biggest decline on record according to data released by the government on Thursday. The Hong Kong Special Administrative Region government welcomes the recent positive economic developments and says it will continue to closely monitor external economic developments and their impacts on the territory. A government spokesman said the IMF had given a positive assessment of the global economy and upwardly adjusted its forecast for global growth in 2018 and 2019. He said the IMF's Regional Outlook report had also revised upwards Hong Kong's gross domestic product growth forecast for 2018 and 2019 from 3 to 3.3% and from 2.9 to 3% respectively. These are encouraging signs that the global economy is recovering, he said. On the domestic front, he noted Hong Kong's unemployment rate had remained at a low level of 2.8% at the end of October, while total employment continued to be on an upward trend. Inflationary pressures had also been subdued amid more stable food prices, he added. Overall, we expect our economy to remain resilient with steady growth in 2018, he said. However, the IMF released its Global Financial Stability Report, or GFSR, warning that if Hong Kong's debt level and interest rate increase, it may trigger a financial crisis. The IMF believes that at present, the risk of a Hong Kong banking system is low. On the other hand, it pointed out that demand for high-risk financing has grown rapidly in recent years, and once global liquidity is tightened and interest rates rise, there are risks. Hong Kong's economy achieved slower growth in the first half of this year due to the external environment. In response to this, the chief executive of the International Monetary Fund, Christine Lagarde, said that she believes that under the support of mainland China's economic stimulus measures and the government's tax reductions and expenditure increases, Hong Kong will be able to achieve more sustainable growth. She also said that she hopes to see more measures from Hong Kong in promoting innovation and technology development to promote economic transformation and enhance competitiveness.